On a day like this, red everywhere, anxiety everywhere, what's your take on it?
Well, thanks for having me, first of all, Ed. I appreciate it. Definitely a tough day for public market investors. As a venture capital firm with over 20 years of investing history in the private markets, we have a little bit of a different perspective. Our companies generally don't have the pleasure of being marked every single day. They can take a little bit of a longer term view. So essentially, a lot of these companies raised money in 2021 at, when capital is fairly cheap historically and at fairly high prices. And our perspective is a lot of those companies are going to come back into the market in the next couple of years and not face the same kind of cheap capital environment. And so we're sort of expecting that what the public companies are seeing right now is going to trickle back down into the privates over time. But there's a lot private companies can do in the intervening period to make their businesses a lot more attractive so that when they do have to access the financing markets, they'll look a lot better.
You have the experience, of course, of looking to your portfolio. Some of those companies in the past have gone public, of course. Come with me into my Bloomberg terminal, take a look at this chart. You want to make a key point, which is that perhaps we've seen this before, right? What we're seeing on our screen is that there is a single metric that shows the magnitude of the current downturn that we're seeing. And that's a retreat in revenue multiples for a specific corner of the technology market. Left hand of your screen, the blue line, Amazon, back in 1998 through 2000, 2001. Right-hand side, Shopify. Why are you looking at this data?
We are always looking at the public market multiples that apply to revenue, as essentially we invest in growth assets that aren't usually profitable. And so the rate of growth of the business is very important, and the expectation of future growth is very important. And I think in the days where you have ascendancies of new platforms, there's a lot of enthusiasm around the new thing. And that can often create speculative asset bubbles, which is sort of something that's common throughout financial markets. And some of what's happened in the last few years, in addition to being pushed on by the pandemic, we feel like are parallel to what happened in the dot-com bubble with certain names that really benefited from the shift to e-commerce.
Right.
But the other thing to just consider here is that Amazon's still around, and it's a very, very valuable company, and it saw its way through a 96% share price collapse post the dot-com bubble. And not to say Shopify is going to continue to go down. Maybe it will, maybe it won't. But we also believe that's a very durable business. So the chart, it sort of tells a few different stories at the same time. We personally take a view of optimism, and that these speculative bubbles come and go, but some of these businesses are building real value for the long term.
Right, you were looking on our screen, some of the pain in technology shares over the last 7 days or so, the likes of Apple, some of those mega caps like Microsoft. I am fascinated with the private markets. We broke a story on Tuesday that SpaceX is raising more money at a valuation of $125 billion. It was valued at around $100 billion in October. When you hear about that, how do you assess valuations right now, and what do valuations look like in the coming months, especially with the backdrop of a Fed that looks determined to raise rates?
This is a conversation we have a lot internally and with some of our peers at other firms. There is a big valuation reset that's essentially happening right now, not as in the public, because again, these are not publicly traded securities, but the private markets always look to the public markets for some sort of guidance on valuation. And so, essentially, for a lot of businesses, your multiple has been cut in half, maybe cut by 3x over the last 6 months. And so those businesses are essentially going to have to get back to par before they go out and raise again in this environment. And so we're really stressing the importance of cash flow and becoming default alive in this environment, which essentially means that you can ratchet up and down your sales and marketing spend and maintain a relatively modest burn while the volatility continues to play out. And we certainly expect the volatility to probably increase before it decreases again.
Right. Very quickly, Alex, what I'm seeing on my screen is the share performance of names like Airbnb, Snap, Uber over the last couple of years. But these are names that were created in periods of stress. I am thinking back to 2008, 2009 and the financial crisis. Very quickly, what would your advice be to a founder right now with the markets as they are?
Absolutely. The first thing is to stay optimistic. So while it might be a little bit difficult to do if you're looking at your own personal stock portfolio, the reality is that a downturn in a capital constrained environment often produces some of the best companies. Companies can really focus in on what they're great at and ignore things that are extraneous. Talent tends to stick around longer, and people are kind of not choosing between as many different jobs, so you can keep them engaged for
Right.
longer. You can really have the time to really hone that business model because you have to survive. So we invest in all cycles consistently. We've been doing it for over 20 years. And
Right.
I do think that there's also some advantages that companies can have during a downturn, but that's presuming that you can get control of your business and do it decisively.